Let's bring in Ted Oakley, founder and managing partner of Oxbow Advisors, to discuss the FAANG stocks. Ted, thank you very much for coming on the show.
Thanks, Sean.
So this is it's interesting. I've noticed the FAANGs coming up in a lot of discussions lately, and I guess just that, at a higher level, as a group, how would you gauge the FAANGs right now?
Well, I think people still live off of them, from the last couple of years. But if you and let me preface that by saying we still own some of them, but they're not. None of them are as high as they were last September. Mm-hmm. I think that's what has people confused a bit because, they came back quite a bit, but they never made it back to where they were, and so they've been sort of stuck here.
And if you hear a lot of investors start, and they've been saying this for a while. This is like the .com bubble all over again. Mm. Do you agree with that, or do you see something legitimately different out of these FAANGs that is kind of maybe a little bit of an overstatement?
Well, I would say, Sean, that the difference is this. I think people, when they're thinking about the .coms, and I was obviously very much in the markets then and knew what was happening, and I thought they were extremely overvalued, but they're more like the unicorn stocks are, the .coms were. They didn't make any money, didn't have any cash on the books, no revenue in many, many cases. And if you look at the FAANGs, notwithstanding the fact that they can correct with the market, there's no question about it. However, most of them have quite a bit of cash. They have pretty good runways on business, and they're in a little different category than the others are.
And I guess just looking at in terms of how you're viewing the FAANGs, it says you actually are not holding one of them, and that's Netflix.
We don't hold Netflix. We think it's fully valued. Our largest holding over the last 3 years really has been Microsoft, which is one of our favorite companies. It's fairly fully valued right now. And we hold the others. We just hold a reduced amount. If you look at the normal S&P 500, that's going to be a 21, 22% holding as a group, and we're probably 10 to 12.
And I guess just I want to kind of focus on Netflix here just for a second.
Yeah.
Is that something that you just feel the stock, either the organic growth for Netflix is going to slow down, or is this change due to, I'd say, some of the more competitive pressures coming into the field with a lot of what we've been seeing out of Disney, AT&T, all the other streaming businesses coming in? Is it more, it's gotten a little bit more competitive, and that's why you think that you've squeezed everything you can out of it?
Well, not exactly for us. It's more about the amount of debt they built up and what they have to do to overcome that to make money, going forward. I don't think people are going to leave Netflix. I think they'll use Disney. There's really be probably 4 streaming places for them. But if you look at what they'll be earning, debt levels, and where the stock's priced, we just think it's really full.
And then I think it's interesting that you focus in on Microsoft, and then you also like Amazon here. I think a lot of people focus in on Amazon Web Services, which is cloud. Then Microsoft, you have Azure, which is also kind of the cloud-related business. So
right.
Is this really a statement just on your belief that the cloud is really where you want to be in the tech space moving forward?
Well, the cloud is where you really want to. If you think about the changes for business, the big change in business is going to be moving to the cloud, and so. It's not, I think people think that a lot of businesses have already gotten there and there's no market left. Actually, just the reverse. Mm-hmm. There's a lot of business left to have in the cloud, and I think those top 3 companies will do well with it.
And then I think the last thing I want to touch on, Apple. It's a very popular name across the street amongst both individual and institutional investors. And I think some people describe them as a little bit of a company in transition. So how do you see, is that what you view it as? And how do you see them wanting to maybe transition over to a little bit more of a services-oriented company? How does that view or change?
Well, we really don't classify them as a tech stock per se, because they're really a consumer stock when you look at a tremendous loyal following right now. But I'll tell you, I go back to the days of Sony, 1995 to 99, and everything was Sony. If you didn't have Sony, you didn't have anything, and everybody thought that stock would rule everyone. And so you never know 10 years from now what might happen. However, for the time being, they've got a tremendous loyal following. They're introducing some new products, and they've got a lot of money. So we'll just have to see if they continue that after the next 3 to 5 years.
And then real quick, because we got to wrap here, Facebook and Google, should we be concerned about the privacy laws changing on them?
Well, they're going to be on them. I would say Facebook in my opinion, Facebook will have a lot bigger problem than Google will. If I had to pick the one that would have the most trouble going forward, it would be Facebook.